Um, I am here again with my friend Daniel Roberts from Australia. So it's like early morning, right?
Yeah, 5:30 a.m. No
5:30 a.m. You know, I sometimes put cameras outside my door to see what's going on at 5:30 a.m. Maybe there are animals I never heard of, or I don't know, because I try to avoid those hours. But thank you for waking up so early. By the way, as I said, my neighbor from JP Morgan is Gili Zimmer from JP Morgan, and he says hi to you. So it's funny. He saw that you're speaking here and he was very much excited. So before we'll open our discussion today that is fascinating again about what's going on in the blockchain space and renewable energy, which is, of course, where this industry is headed. Just a couple of words about Daniel. Executive chairman and co-founder of Iris Energy. Prior to founding Iris in 2018, Daniel's professional experience spanned the finance, infrastructure, and renewable energy industries, and in 2018 exited as the second largest individual shareholder in Palisade Investment Partners, an infrastructure funds management business managing $8 billion in direct infrastructure assets across 23 businesses, which explains how you know him from JP Morgan's infrastructure fund. Daniel was responsible for Palisade's origination and investment activities, as well as the management of a number of portfolio assets, including serving as a director on the board of Palisade, as well as many of Palisade's investee companies. Prior to joining Palisade, Daniel spent time in M&A advisory, debt structuring, and principal investments with Macquarie across both Sydney and London, and with PricewaterhouseCoopers in their Sydney office. Daniel holds a Masters of Finance Dean's List from INSEAD, which are our partners at the UAE conference, by the way, business school, and Bachelor of Business from the University of Technology in Sydney. So first of all, very early morning for you, Daniel, in Australia. How are you doing?
Good afternoon to you, Denny. I'm doing very well, thank you.
So maybe before we'll start, I'll ask you what's going on COVID-wise. You know, I hear you guys, you know, the borders are closed and stuff, and I wonder if you guys are what's waiting for us soon. So what's going on?
Yeah, I mean, we had a pretty good run down in Australia. We were opened up quite early. I guess one of the benefits of being a large island, isolated to some extent from the rest of the world. But I think what's been reported is this Delta strain has come in and just taken off, and with low vaccination rates, because we've been open, and I guess there's been potentially a little bit of complacency. Despite being locked down, the numbers are still going higher and higher each day. So we've been locked down for 5 weeks so far. That's been extended to the end of August, and yeah, I've stopped speculating on what might happen.
Well, good luck with that. Okay, let's start getting into our story here. So your management team seems full of people with energy, infrastructure, and data center backgrounds. Can you talk us through how you came together in this business? Really, give us a little bit of overview of maybe yourself as well. I read some of it, and how this came to be.
Yeah, very happy to, Denny. So I guess it is unique to bring so many people together from around the world with all the right experience across all the disciplines involved in a business like this. And I think despite what you might think from the outside, like there's no crypto or blockchain people really in this business. It's an energy and infrastructure platform where fundamentally we're building out sustainable data center business across the world, and the immediate opportunity. And I come back to what that sustainable data center business looks like in the long term. But today, the immediate opportunity is this frankly ridiculously profitable and an asymmetric business, Bitcoin mining business. So in terms of all the ingredients, if I can call it that, to go into a business like this, it's energy, it's infrastructure, it's data centers, it's construction, and we have assembled a fantastic team from around the world. So our two Canadians, Brian Fair and Brian Fry. Brian Fair built a very large construction business across Western Canada, building large-scale high-tech sawmills in regional areas. He holds the Order of British Columbia, obviously a very well-known Canadian. Brian Fry actually co-founded a company called Rackforce in the early 2000s, which grew to be one of Canada's largest cloud computing data center platforms before he sold out to a listed company, TerraGo, a few years ago. And then more recently, we've now got about 40 people across North America and Australia. A lot of ex-Macquarie bankers, renewable energy developers, engineers, investors, asset managers. It's a real asset platform. And earlier this year, we were fortunate enough to bring on board two of Australia's most credentialed listed energy and infrastructure public market managers, David Bartholomew and Jason Conroy. They, as CEO and CFO of the listed Duet Group in Australia, grew that from about a $1 billion market cap before selling out to CKI Group in Hong Kong about 4 years ago for $13 billion. So they've agreed to join us as independent chair and CEO, respectively. So look, it's a fantastic team. We've been very lucky in terms of the quality and the experience of the people in that platform, and it certainly helped us grow very, very quickly in a sector that is growing very, very quickly.
So as you can see, I surprised both you and me by asking the questions in the wrong order, which is why this is a great session, because I am full of surprises. So now that I have the right order of questions, obviously, the first question would be if you could, again, tell us a little bit about your background and how you came to found Iris. And, you had a huge success in infrastructure, very early on. So how that happened and how it led you to Iris, really. If we can, again, talk about that part first.
Yeah, sure thing. Look, I think if you look at what Bitcoin mining is today, and it's part of the verticals within this sustainable data center outlook for the business, which we should come back to later on. But if you look at the nature of the sector today, it's all about the energy, the data center infrastructure, and building out really large scale businesses, accessing institutional capital. And you've seen a lot of the competitive advantage in the space change, because it used to be with the manufacturers of the technology and on the chip side. But we can come back to that a little bit later on as well. With the commoditization thesis of these computers, everyone has access to the same computing power now. Everyone has the same efficiency equipment, which means it is all about the energy, the data center infrastructure, and the governance of a large institutional grade infrastructure platform. And I think when you look at our backgrounds, that's obviously where we've come from. What we haven't spoken about, I guess my background, as you mentioned, PwC, then Macquarie across Sydney and London, developing infrastructure and renewable energy projects. And then 10 years ago, joined a business called Palisade Investment Partners, as you pointed out. Look, right place, right time. We grew to about 8 billion in assets under management. So ports, airports, gas pipelines, wind farms, solar farms. Again, a lot of greenfield construction assets. And then got to mid-2018, I stepped back from my executive role there, was still the second largest individual shareholder, but decided to focus more on private portfolio and a couple of new growth businesses. My brother and co-founder, Will, he was also at Macquarie prior to that time, doing structured products into traditional mining businesses. So gold, copper, iron ore, etc. And for the last 12 months, he was at Macquarie. He was involved in setting up their digital asset team. So this was back in 2017. So look, they started looking at Bitcoin on the CME Futures Exchange. They invested balance sheet in Bitcoin mining Again, 2017, 2018, relatively early on. And then I think it's fair to say that, you know, Macquarie's appetite potentially cooled mid 2018. So at that point, Will jumped out of the bank. We teamed up, and that was the genesis of Iris Energy. And I think in terms of our exposure to Bitcoin, look, we first came across it at, you know, around 2013, and did what I think a lot of people potentially do, or that's what I like to convince myself, which is buy high and then sell low during the volatility, because you can't handle it, you don't understand it. And I think over time, as you notice that Bitcoin just doesn't seem to die, it seems to hang around. Yes, it's volatile, but it's volatile within this extraordinary range of value accretion. You become more comfortable with that. And I guess once we entered this paradigm of saying, hang on, this Bitcoin thing, it doesn't look like you can kill it. It's here to stay. It's one of humanity's first inventions that just doesn't seem to be unwound. Like it's just beyond the control of individual humans now. The game theoretic incentive structure, the way the algorithms are programmed. And I think once you sort of cross that, you then say, well, hang on, with its increasing scarcity characteristics and this halving event every 4 years that cuts the supply of newly issued coins in half to the ultimate cap of 21 million coins, gee, if it hangs around, then it's very possible that this seems to create this positive flywheel effect of the store of value, where the longer it stays around, the more it holds its value, the more time it survives, combined with its increase in scarcity, it feels like it could go up considerably in value. And I guess it was that conviction in Bitcoin as an investment thesis. And look, there's no absolutes in life, but it seemed like it was a, you know, something that I guess the world was progressively awakening to. And again, we're seeing that awareness grow and grow in the year 2021. When you combine that with the energy, the infrastructure, and the data center ingredients behind Bitcoin mining, hopefully that gives you a little bit of an insight into how we came across the sector and why we thought the opportunity was interesting a few years ago.
Now, it's good to understand the mining economics, really, particularly with reference to how your profitability changes as the Bitcoin price moves around, which we're seeing now. Again, it rebounds, right? In the last couple of weeks, I see it's quickly getting back on track. So if you could talk about that.
Absolutely. So this is one of the aspects of the business that probably isn't that well understood, but it's not overly complex. So the analogy that I use to describe Bitcoin mining is, if you go to the casino, dealer puts a pile of chips in the middle of the table and says, first person to roll 2 6s wins the pile of chips. All Bitcoin mining is essentially that on a digital scale, where every 10 minutes the protocol generates a random number. All these computers around the world use trial and error brute force to guess that random number. First computer to do so wins a few $100,000 worth of Bitcoin. Process starts again. There is no edge. It is entirely probabilistic. The more computers you have, the more Bitcoin you will receive. So if you've got 1% of the global network computing power or the global hash rate, then on average, you'll find 1 out of 100 blocks and win that Bitcoin. Now, in practice, what people do is they aggregate their computing power with others through these mining pools. So look, we're part of a mining pool that controls around 15 to 20% of the global network. What that means is they find the Bitcoin reward every hour or so. They then allocate that Bitcoin on a proportionate basis to all the contributors to the mining pool. In fact, it gets better. To show how predictable this is, this mining pool guarantees us a fixed daily payout in Bitcoin, directly corresponding with the amount of computing power we send them each day. So every morning, our CFO gets into work, logs into our regulated exchange account. The expected number of Bitcoin are sitting there. He sells for cash. We withdraw that cash to our bank account. We pay the power bill at the end of the month. We pocket the rest as profit. That is it. That is the entire business. It is no more complex than that. We don't hold Bitcoin. We don't speculate directly on the price of it. We certainly don't touch anything else crypto or blockchain related. it's a daily cash flow monetization process of a real asset base. So further to your question in terms of how the mining economics change with reference to changes in the commodity price of Bitcoin, this is where you see some parallels with traditional commodity industries, but you also see some fundamental differences. Now, if we start in a normalized market, and we're not today, and I'll come back to why that is and where the price is, but in a normalized market, as the price of Bitcoin goes down, high-cost miners can't pay their power bill, right? So what they do is they switch off. There's a global cost curve like traditional commodities. Arguably, Bitcoin mining is far more elastic because you're dealing with PowerPoints and computers versus large industrial gold mines, etc. So what this means is as the price of Bitcoin goes down, high-cost miners exit the cost curve, which means lower-cost institutional miners like Iris start receiving more Bitcoin because our share of the network goes up. So what this creates is a really unique dynamic where as the price of Bitcoin goes down, so does your unit cost of production, creating a really unique downside protection in your cash flows because your power cost is unchanged, but you're mining more volume. You're getting more Bitcoin each day because your share of the network has gone up. Now, the key to unlocking a lot of the early institutional interest in our business last year was down to us being able to show a track record of operations at our first facility, being able to clearly articulate that dynamic, and people starting to get comfortable that there's a far broader utility or use case beyond this data center platform than just Bitcoin, which we can come back to, but also the exposure to Bitcoin through what we're doing is far from a 1 and 0 proposition. It's very nuanced. It's a daily cash flow process. Yes, there is absolutely a correlation to Bitcoin, but it's quite asymmetric for the reason that I've just gone through. Now, where the asymmetry then manifests itself again for different reasons is when the price of Bitcoin goes up, which is obviously where more of the focus is lately. So as the price of Bitcoin goes up, all those high-cost miners switch on their computers again, and the hash rate or the global network follows the Bitcoin price. But that can only persist until you hit the old high watermark for global computing power, at which point people say, hang on, I've got no more computers to switch back on. I need more new computers. I need more low voltage power. I need more data center capacity. I need more energy. I need more capital. And this is where the model is fundamentally breaking down and the whole sector is being turned on its head. So this is the whole macro thesis for Bitcoin mining, right? And what it comes down to is a dislocation between the real world and the digital world. So the digital world is your revenue line, right? It's the price of Bitcoin. And exponential technology, price moves in a non-linear fashion, goes on these parabolic adoption waves as we've seen time and time again, unconstrained by the real world. But your ability to monetize that and generate cash flow from it through Bitcoin mining is all about the real world. And the real world starts getting really hard when you need to build out large scale energy and data center infrastructure projects. So we refer to a triple M construct in our business, which is in order to bring online more mining capacity in this sector, an individual must get money, the first M. They need to get miners, the second M, the computers out of China. And thirdly, they need megawatts, the power. So money, miners, and megawatts. And it's the lowest common denominator effect. And if you can't get one of those, you're not getting a piece of this digital exponential pie every 10 minutes. Now, to illustrate why we've hit this inflection point in the industry, I'll go back in time to where there was, say, 50 megawatts of global power dedicated to securing the Bitcoin network. Bitcoin goes on one of its 5-10x runs. The world can scramble and normalize mining profits. And I say normalize in that way because normal yields in this sector are 1 to 150% per annum on those chips. But when you're only finding a few hundred megawatts worth of additional power to normalize those yields, the world can scramble. It can find it. People can plug in more computers at home. They can find a bit of extra data center capacity, etc. But when we're sitting here late last year and there is 8 gigawatts of power servicing this network, and the price runs 5x from 12 to 60 grand. It is a completely different paradigm. All of a sudden, if we go back to that triple M construct and play it out, megawatts, you now need 30 gigawatts of power. The entire global data center industry is only something like 23 gigawatts. Money, you need $70 billion of capital investment in a sector where institutions are still wrapping their heads around it and they're working hard. And the sum total, though, of all listed miner issuances in the past 12 months is closer to $2 billion. And then thirdly, even if you sold for those two, you're still having to wait years of full manufacturing production of these specialized chips out of China in the middle of a global semiconductor shortage where people literally aren't able to build cars because they can't get the chips. So it's enormous. And this is the real world triple M constraint, building out billions of dollars of infrastructure and capital and chips, all to chase this exponential digital and social network that's operating completely unconstrained by those real world effects. So what this means is the macro opportunity for Bitcoin miners is enormous. Like these profits, they are real. They are here to stay. We are banking the cash flow every single day. And for a business like us, the opportunity also was those tens, soon to be hundreds of billions of dollars that are going to be economically incentivized to come into this sector and get a piece of that digital exponential pie every 10 minutes. They're going to need a way in. And we saw a real opportunity to build an institutional grade infrastructure platform to help facilitate that over the years to come.
And how is this, and I see we have some questions, we'll get to it in shortly, how this industry really evolved, like, you know, the around computers and hardware, and I guess when Bitcoin started, then around there, people started to mine, and but happy to hear from you a little bit about that.
Yeah, and this is one of the other aspects of the industry that's fundamentally changed, right? So if you go back and look at the history of Bitcoin mining, it started off with hobbyists and enthusiasts on their laptops and computers, mining 50 Bitcoin every 10 minutes. Well, that would have been fantastic if we all had a time machine. And then it evolved to graphics cards, and people realized that they could run this random number generator faster, more energy efficiently using GPUs. And then around 2014, the Chinese developed ASICs, application-specific integrated circuits, whose sole purpose in life was to crunch this SHA-256 algorithm, which secures Bitcoin. And from that point, these manufacturers largely held the competitive advantage because they had access to the latest technology. So they would mine anecdotally on their own balance sheets. 6 months later, develop more efficient chips, sell the old stuff to the general public, rinse and repeat. So as the average participant in this market, you never really had a hope of competing for those Bitcoin every 10 minutes because there are others also doing the same with generations ahead, technology-wise. Now, our thesis when we started this business is that you would see commoditization of that hardware, that it would go the way of other electronic hardware industries, LCD TVs, laptops, computers. We saw it firsthand with solar panels, the evolutions from the early 2000s through to today. And what's now unfolded is that's complete. These manufacturers have now caught traditional computing. They're now competing with the likes of Google and Amazon to procure 7-nanometer wafers from TSMC and Samsung. And what this means is it's now a much more level playing field. Everyone can buy the same chips. Everyone can go to these manufacturers and buy the same efficiency chips. There's no competitive advantage, there's no differential. And what this does, as you can see from the landscape of Bitcoin mining and the key inputs, is it completely shifts the competitive advantage going forward in this space, or it has for a couple of years now, away from the manufacturing and the tech towards the infrastructure side. So towards businesses that can build out large-scale data center infrastructure platforms, start mobilizing institutional capital to build out businesses of scale.
One of our guests here that is asking a question is a good friend of ours, and he's behind one of the largest exits in Texas. Voice over IP is a good friend, and I will not mention his name. I will just mention that he'll be speaking at our conference that we moved to February, and he doesn't even know that, but I will let him know. And he's asking this: proof of work networks require high computing power, but proof of stake is moving away from that, which provides lower cost, higher capacity, and faster operation. Ethereum is planning to move to POS by the end of this year. Several other POS technologies are also gaining popularity. Question number one: do you believe Bitcoin will migrate to POC to be less energy intensive? And number two, if so, when and how will your business adapt?
Yeah, look, it's a good question, and it does pop up. I think it's important to step back and realize that proof of work is fundamentally one of, if not the key innovation that led to this entire cryptocurrency space. And it's the proof of work concept that ensures that this blockchain is layered down in digital concrete every 10 minutes, where the transactions, the code base is cemented down in layers of SAP every 10 minutes, because it's this intrinsic link to real world energy and infrastructure spend. Because in order to, because if you step back and look at why people value Bitcoin, right? It's because of its scarcity characteristics, the fact that it's immutable, censorship resistant. Like, no one can stop anything on this network. As I said before, it's one of humans' first inventions that just seemingly cannot be unwound. And part of the key innovation of this space is because it's layered in this proof of work every 10 minutes, because in order to try and tamper with the blockchain, you need to try and somehow overcome those billions of dollars of investment and expenditure on electricity every 10 minutes to try and tamper with it. And even then there's limitations. So it's really important. Like, Bitcoin, in my view, there is no chance it will ever move away from proof of work, because it's the fundamental innovation that creates what Bitcoin is. Like, proof of work and Bitcoin are synonymous. It's one and the same. I think it's also then important to distinguish Bitcoin from blockchain or crypto. And as I said, like, the former is a self-sovereign and scarce digital monetary asset, e.g. gold 2.0. Now, it's got a 12-year track record of anti-fragility, immutability, censorship resistance. Whereas the latter, I think they describe and relate more to emerging technologies, tokens and protocols with varying degrees of prospective use cases. As I said, like, Bitcoin's proof of work consensus algorithm is precisely what gives Bitcoin its value and preserving all those characteristics. Whereas I think proof of stake and other consensus algorithms are more based on voting mechanisms rather than this real world energy spend, which is far more likely to suit the flexibility required for their prospective use cases. So look, I'm a fan of crypto more broadly. I find it a little bit more difficult to understand at times than Bitcoin. If I look at Bitcoin, it's been a finished product for 10 years. It's got product market fit, it's store of value, gold 2.0, whatever label or narrative you want to attach to it. But it's been a finished product for 10 years and has solved a lot of problems. Whereas I think crypto, blockchain more broadly, there's thousands of tokens, I've lost count these days, all trying to solve different use cases. Some will fail, some will succeed. In terms of putting value on these tokens, I personally struggle, but do I believe in what they're ultimately trying to achieve? I think I do, because if you look at the way the world's going, the world is migrating more to peer-to-peer engagement, disintermediating these central authorities, engaging more in a peer-to-peer fashion. And blockchain and crypto is the technology by which that occurs. And if proof of stake is a way to implement a consensus mechanism that is more optimal for some of those other use cases beyond a store of value, then look, the market will obviously put that in place, and we'll see the results.
Now, it brings us to the renewable side of things. So where do you secure your power? How do you think about that? What's been the impact of China's recent move on Bitcoin?
Yeah, and look, electricity is obviously the key input cost for Bitcoin mining. Back to what I was just saying around the proof of work, it's that real world energy expenditure securing the blockchain that gives us all the confidence to know that if we go and buy, half a Bitcoin or one Bitcoin, then we've got half a Bitcoin out of 21 million that will ever be created. We can bottom draw that and know that no one can ever take that away. No one can ever stop us transferring it. We can take it to different countries and it will hold its value as a percentage of all those coins outstanding. So that electricity component is fundamentally important. Now, in terms of the way we've approached it, we've said from day one, though, that not only will we only use renewables, I mean, that seemed semi-obvious to us coming from an institutional funds management and infrastructure background and the focus on ESG. We obviously see others restarting coal and gas-fired power stations, and look, that's a matter for them, I guess. But in terms of taking it more broadly, we also will only enter a market where the incremental load we are bringing to the market is solving a problem, is doing a social good. Like, this is fundamentally way beyond ESG and institutional acceptance of those thematics. It's about also de-risking your underlying business, because as a really large-scale energy user, you will come under increased scrutiny for your use of energy. And we've already seen this recently with Elon on Twitter and the Chinese crackdown and the whole energy debate in the space. I mean, this is only the beginning, to be frank. The only thing that surprised us about this debate is it's 5 years too early. But the amount of energy and electricity that's going to be economically incentivized to secure this digital exponential network over the next 5, 10, whatever years, already preloaded into the current Bitcoin price, let alone what Bitcoin might do, it's going to be enormous. And the social pressure that's going to come to bear, it's not going away. And it's this narrative around diverting electrons away from mums and dads and industry to securing a magic internet money that, only a smaller amount of the world's population understand, albeit growing rapidly. So it's very important to behave in a socially responsible way. So our focus has been on markets like British Columbia that are facing an oversupply of electricity. 97% of their network is hydro. They're still building large-scale hydro in the north of the province in the face of decline in manufacturing and industrial demand as the pulp and paper industry has closed down there. So for a market like that, because it's regulated, if they have an oversupply of power and don't have new users, paradoxically, power prices need to go up because the utilities under the regulated model are entitled to charge higher power prices to earn their regulated return on investment. In deregulated power markets, it's all about the flexibility of load and being a demand-side battery and really supporting the build-out of intermittent renewables like wind and solar, where you've got this time of day production issue that causes strain on energy networks. And this isn't about co-locating next to a solar farm or co-locating next to a wind farm. It's recognizing that grids, and we mentioned Texas before, we've got a number of sites under development in Texas where they've got heavy renewables penetration in the grid. And if you can bring in a load that can behave flexibly and respond to market events, that's extremely valuable. So, and we're only talking turning off 1 to 5% of the year. And to unpack that a little bit more directly, these are the perfect flexible load demand response products because you can remotely throttle down the frequency of these chips and dynamically reduce their energy consumption. You can then turn them back up. So they're the perfect for adapting to peaks and troughs in local power markets, absorbing excess power, which by definition, when it's cheap and it's excess, people don't want, but also reducing power consumption when power prices are high. Bitcoin miners are economically incentivized to do so. And by definition, the power prices are high because other people want it. So let them have that power. That obviously also helps the economics of a Bitcoin mining business because it lowers your cost of power. But fundamentally, our view is that you have to behave in a really socially responsible manner. And the recent, debate over the last few months has only served to highlight that further.
Now, Bitcoin versus crypto. Do you mine and other cryptocurrencies? What's your view on the space in general?
Look, I think we've probably covered my view on the space in general off the back of the proof of stake comment and the Bitcoin versus crypto. I think at this stage, look, we are focused on Bitcoin, right? It's an institutionally accepted asset. I think it's certainly crossed that bridge of being accepted and endorsed as an institutional grade asset. We mine it every day. We still liquidate it every day nonetheless. Look, other cryptos, they're on a spectrum of use cases, value, probability of success, etc. Look, while these computers could be used for other coins or cryptocurrencies that use the SHA-256 consensus algorithm, the same proof of work mechanism that secures Bitcoin, we're sticking with Bitcoin only for the foreseeable future, at least.
Now, we talked about your management and the backgrounds because I surprised you with that as a first question. So electricity is the majority of your cost base, and I assume it's very important to keep it low. If you can talk about that a little bit.
Yeah, and look, power prices, as we mentioned before, are the key input, and it is important to keep an eye on your key input costs. But I think, and again, the way the sector's changing is there are other aspects of this business to do with power that need to be thought about a lot more strongly. And it's, there has been a message within and outside the industry that you need really, really, really cheap power to be competitive in Bitcoin mining. And look, historically, that has somewhat been the case with the regular upgrades in technology, the competition that can emerge because of the law of small numbers. When you've got a small industry and it's easy to bring online more supply, more capacity, then it's easier for new competition to enter the space and therefore cannibalize the profits and the piece of this digital exponential pie every 10 minutes. But given the commoditization of these computers, given the fact that we're now dealing with tens of billions of dollars of requisite energy data center infrastructure spend, you've got this real world lag and this struggle where the real world can't keep pace with the digital world anymore. And what this does is it changes the goalposts, where today you look at all these Bitcoin miners, right? We're using the latest computers, we're generating revenue around 40 to 45 cents US a kilowatt hour. Like whether your cost of power is 3.5 cents or 4.5 cents, back 5 years ago, maybe it was more important. But today it's the difference between say an 88% gross profit margin and a 91% gross profit margin. Yes, it's important, it's bottom line, but I think the focus of the industry is now swaying towards, well, hang on, how sustainable is that access to power? And that doesn't necessarily mean sustainable as in green, but that's absolutely part of it. It's like, how secure is your access to electrons? Like, does this become more of a binary equation where are you going to be allowed to mine Bitcoin using fossil fuels in all these different jurisdictions around the world? What security over those electrons do you have longer term? And I think that's why our energy strategy has been so focused. And look, it's our credit and infrastructure background. We're always glass half empty, focused on the downside, what can go wrong? And it's all about, well, what can go wrong? What can lose our access to power? Because I'd rather have and I'm not saying we've got very cheap power projects in Texas. So I don't want to suggest that we don't have cheap power, but would I rather an 88% gross profit margin with a really secure, low risk, long-term business supply chain? Or would I rather 91% take in incremental risk and using gas and coal and other energy sources that may be frowned upon by different groups of society? I think we've probably elected for the former and to focus on the risk side of the equation rather than optimizing every single dollar of potential upside.
Now I have a couple of questions, but just one Lost for me. I see from your website and LinkedIn that you don't use shipping containers like many other players in the industry. Can you talk us through the advantages or disadvantages of building data centers instead?
Yeah, look, and I think this is part of the whole evolution and institutionalization of the sector. And people are now learning that cramming as many of these computers into a shipping container as possible probably isn't the best way to manage a long-term infrastructure business and looking at longevity of cash flows. And I think it's a relic of the past. I know it is, because previously these computers didn't last long. So you would replace them regularly, just put them in the shipping container, put them in a warehouse, run them as hard as you can, generate every Bitcoin you can out of every machine, and then on to the next machine. But given these computers and their projected life from today, given that commoditization thesis, given the inability of the real world to chase that digital world, I mean, for reference on that, even the first industrial era chips that were released around 2016, the S9s from Bitmain, they're still generating revenue around 13 to 14 cents US kilowatt hour today. The stuff that the industry is buying from the manufacturers, the 7 nanometer equivalents from the TSMCs and the Samsungs, etc., they are more than 3 times more efficient. So these chips will last a really, really long time if you look after them. They're just microchips, right? They'll last a really long time if you keep them dry, if you don't let dust get into them, if you don't overheat them. So look, we've been really focused on, again, it comes down to risk. Like, the returns are there in this sector. Just look after these chips, look after your asset base. So yes, we do build data centers. We've invested years in R&D, in optimizing the ventilation, the operating conditions for these chips. We've got automatic exhaust fans that ensure the optimal ambient temperature for operating these chips. So even in summer, the exhaust fans will automatically dial up and down depending on the ambient temperature to optimize the internal temperatures. And in winter, we'll recirculate some of the output heat air into the intake, because the operating temperature at an efficient level is around, the optimal is around 10 degrees Celsius. So what this means is that we're receiving uptime, which is, anecdotally a lot higher than our peers. And the issue when you're housing a shipping container or you're not optimizing for that is, every time the ambient temperature hits 27, 28 degrees Celsius, the computers can shut down and choke on themselves because of that heat getting trapped. And that's not good for the machines. It's also not good for your revenue line, because if you're closed down or you're not operating 20% of the year and your revenue line is around 40 cents US a kilowatt hour, that's 8 cents a kilowatt hour. So there's a lot of focus on whether your cost of power might be 3.5 or 4.5 cents. But what about the 8 cents that you've just left on the table because you haven't optimized your infrastructure or looked after these chips, let alone the long-term effects?
Now, I want to show you this. So this doesn't surprise you too much. An article about you guys raising capital before IPO, right? Iris Energy is planning to raise about $200 million in a new fundraising round before it seeks direct listing on the NASDAQ, according to a person familiar with the matter. I think you are a person that's familiar with the matter. So if you can talk a little bit about this, and then we have a couple of questions I see from some folks here.
Yeah, I'm probably restricted from talking too much by our US counsel on commenting on the listing and our capital raising plans. But look, very happy to deal with questions offline. Look, what I can say is we're a capital intensive business. We require new capital to continue investing and growing our business. We have been very fortunate in securing a very large number of computing power contracts with the Chinese manufacturers. We've got a global portfolio of sites we've started constructing and building out, including our first full operational site in British Columbia. That will require capital. We will look at our capital market options. We're working with a number of US advisors at the moment around those options. I think Eddie Sugar from EAS advisors might even be on this call is one of those players. So look, probably best I deal with that offline, Denny.
And so we have a couple of questions coming from several different directions. I wonder which one I will choose now. Maybe we'll start with Daniel here. Why don't you hold any of the Bitcoin you mine? Are you not long Bitcoin? I understand that you look it as just a power energy arbitrage type of business.
Yeah, look, we've all got conviction in Bitcoin. We wouldn't be mining it if we didn't, and personally, a number of people hold Bitcoin. But I think our view is that a couple of things. One is our investors don't need to pay us to hold Bitcoin. I would rather generate the cash, distribute that cash in dividends, and if you as an investor would like to hold Bitcoin, that's a matter for you. You don't need to pay us to do that. Equally, if you start holding Bitcoin on your balance sheet as a Bitcoin miner, arguably you're doubling down on risk, because if Bitcoin goes down, you're getting hit on your P&L because you're making less money from mining Bitcoin, and then you're getting hit on your balance sheet as well because the amount of your stock is going down. Yes, you're leveraged more to the upside, but I don't think it's the most efficient financing and capital structure model anyway. And I think if you look at what we're fundamentally building is like, we're real asset guys. We're energy and infrastructure backgrounds. We're used to managing capital structure, cash flows. To go and hoard digital assets on our balance sheet is really incompatible with who we are, where we've been, and where we're going. And one thing we haven't spoken about is this broader platform that we're building. And we've spoken about Bitcoin being the first use case, but what we've kind of awoken up to is this entire macro thematic where the whole world is being digitized and electrified. And you've got these exponential digital demand drivers driving an insatiable demand for computing power and energy. And this high performance computing space, so applications like rendering for augmented reality, oil and gas reservoir analysis, data analytics, machine learning, all these applications that require a lot of energy and computing power, they don't necessarily belong in these capital city data centers. So we're looking to pivot the platform into that. We're looking at things like green hydrogen. Like ultimately, we're building a real asset base. How we monetize that over the coming decades will no doubt change, where different paths will emerge, different based on how different sectors evolve and at what rate. And to really highlight this, like if you're one extreme, you look at movies like The Matrix and Ready Player One. Like as humanity, we are on that trajectory, right? Whether we're somewhere else, it doesn't matter. You're seeing that same exponential demand driving insatiable appetite for this data center and computing power. Bitcoin just happens to be the perfect manifestation of that dynamic, because you've got an objectively priced commodity where you see that price. You can put a revenue line, an expense line, a gross profit line in your spreadsheet, but the same thing is happening everywhere. And I think that's a long way of saying, answer the question, it's not our core pedigree, it's not our backgrounds, it's not the way we're building this business. It's a cash flow business. We will look to pay out distributions in time and really leverage what we're good at, which is building real assets and monetizing it rather than hoarding digital assets on our balance sheet, which many of us do personally.
What is the cost of power in Canadian dollars per kilowatt in British Columbia?
It depends what network you're connected into. So the network that we're connected into, the high voltage transmission line, it's a regulated market where the power price is a fixed rate for every electron. If you look at the average power price across our 8 development sites that we've published or publicly announced globally, so we've announced 4 in British Columbia, 3 in Texas, and 1 in Asia Pacific. And look, there's obviously a number of people in the business looking at locking up more sites live time. I think if you look at our average power price or the range, it's anywhere from potentially 1.5 cents down at the low end, providing this demand response, flexibility and load, all the way up to say 5 cents at the higher end, where you're receiving base load renewables and solving other problems. So it's all within that range of electricity.
Another question. Oh, it's not a question. Somebody's mentioning that even the movie industry is looking into cryptocurrency. I believe these are the questions I see here so far. We answered most of them. If anyone has anything else to ask, this is the time. And of course, we'll send your contact info to everybody here, so you will be able to do that. And if you haven't been in the session, which you don't know because you're not in the session, but you will receive this recorded session, so you can check it out. Daniel, anything else?
No, that's fantastic, Denny. Great to chat. Thanks for all the good questions.
I am definitely waiting to see you in person. With open borders, and I will surprise everybody now. Okay, so wait a minute. Give me a chance to surprise you. So this is my next guest this Thursday. Now, I hope you see my this picture, right? So another person that I'm doing with a session at an unconventional hour is Shep Gordon. You see this guy here is Shep Gordon. He is one of the most the legendary talent agents in America. Alice Cooper. So many other athletes and chefs and artists and singers, and his wife. Wow, his wives have been amazing, including Sharon Stone at some point. He really lived everything that you read about in the books, from drugs to sex and rock and roll. And I'm going to talk to him. Now he lives in Hawaii. He's 70, I think. He has a 2-year-old. Finally. At some point in life, he decided to stop everything and start his own family, something he didn't have time to do before. One is Mike Myers. Mike Myers did the film Supermensch about him. If you remember Mike Myers, everybody from Wayne's World and all of that, an amazing film. So this is going to be a very, very special discussion this Thursday at 5 EST, because we didn't want to wake him up too early in Hawaii, where they take it easy anyway. So join me then. Daniel, thank you so much for being with us today. I see somebody's asking you to call him. Guys, we'll connect you later on to Daniel. Thank you so much. Stay safe, and I really hope to see you in person very soon. At least we are working on our events, hopefully October 27th at the rooftop of the World Trade Center. We'll be doing our next in-person event, the East Coast Family Office Conference. Thank you so much, Daniel, for being with us again. Good luck with the amazing stuff you do and taking it to the NASDAQ. It's serious stuff.
Fantastic. Thanks, Denny. Always a pleasure.
Bye-bye.
Thanks, everyone. Bye.